Couple housekeeping items before we start. Number one is that we will be posting, well, you'll be getting a copy of Ray's PowerPoint at some point in time. And we are recording this. And Ray, I hope we can share the recording. We haven't really talked about it. If he's open to that, we will be posting it on score.org / akroncanton.org.
And Ray is fine with us
Okay. All
sharing the
right.
recording.
Cool. Um, Ray, are you going to answer questions as we go, or would you prefer the registrants to wait till the end?
I think we can drop some things into the chat, and my colleague Tom Sankrick, who's on the line as well, can answer them as we go. But
Oh,
if it's more of an involved question, Tom might hold it to the end
okay.
so that we can, address it more fully.
Okay. So Tom's going to kind of keep an eye on the chat and the Q&A as well.
Yes, sir.
Yeah, I
Okay.
can do that. Yeah.
Oh, okay, cool. Thank you. Just as this is kind of a process change for us, but if the registrants have any questions for you, we're asking them that put them into the Q&A feature only. Um, just because we can keep track of them better. Sometimes they get lost in the chat. And if you ask the registrants any questions, we're asking them to use the chat feature for that. And if they want to communicate with other registrants as well. So we don't really monitor that as closely. Lastly, you should be receiving a 2-minute survey to give us some feedback on how we can make these webinars any better. So, okay. Next slide, please. My name is Ed Cook, and I am a SCORE mentor in Canton, Ohio. I retired from PepsiCo back in 2012, and I joined SCORE in 2013. And right now, my primary function is to help with these educational workshops. But if you haven't heard of SCORE, we are a national nonprofit organization that began back in 1964. Probably many of you weren't even born at that point in time. Our first chapter was established in Dallas, Texas, and we currently have over 200 chapters. We mentor startup businesses, existing businesses, whether they're for profit, nonprofit, and requesting a mentor is very, very easy. And you can see by the big blue dot there that clients that receive 3 hours of mentoring from us show a better success rate. So, next slide, please. Our mission is pretty simple. Uh, it's to support small businesses. We do that in a couple different ways. One, we offer free and confidential mentoring to small businesses and entrepreneurs. And we provide educational workshops and webinars like this on topics that small businesses can benefit by. We try to make everything free. We believe that small businesses are important to the national economy and they drive some job growth in the communities. Next, please. We sign I'm sorry. Let's see. You can see, well, you corrected it, Glenn. Thank you. We have about 8,000 volunteers throughout the U.S., and we serve about 1,500 different communities. And each mentor has a very unique business skill set. We have people that have retired from marketing, HR. We have someone that recently retired from the SBA. So they have a great business skill set. So. Next slide, please. And we sign an annual code of ethics form. And it basically says that whenever we interact with a client, we cannot benefit in any way from them. And that goes down to accepting a lunch from them, basically. So it's very strict. And the client information is confidential and it's protected by the US government. Next slide, please. Our mentoring is free. Our workshops are free as well, and that's because of a couple different reasons. Number one is we're a resource partner of the SBA. Uh, Number two, we have a number of great local sponsors that are very generous that help support us. And lastly, we have a network of a lot of volunteers that volunteer their time. Next slide, please. These are some of Cleveland's sponsors. The Cleveland Neighborhood Progress, Growth Capital, Truax Law, Comstar, Community Foundation, the Lorraine Community Foundation, Key Bank, PNC, Wells Fargo, and I think there's one under there, Chase. So next slide, please. And there's our, if you want to scan that, you'll get some information about us. But if you're interested in becoming a mentor, so if you think you have something, some business skill set that you think that other small businesses can benefit by, we could use you. Or number two is you can be a become a find a mentor. So with that, I'm going to turn it over to the SBA guys. Guys, it's all yours.
All right. Well, thank you, Ed. Appreciate that. And we always appreciate our partnership with SCORE. I can't say enough how amazing it is to have such a great collection of SCORE chapters here in the state of Ohio, award-winning chapters, mentors that go above and beyond. So hats off to you guys. And again, thank you for allowing us the opportunity to come and talk to some of your mentees today. So hopefully we can provide some good information. I am going to go ahead and attempt to share my presentation. So let's see if we can get this going. All right. I'm going to share. And how does that look? Is everyone able to see that?
Yeah, I can see it.
Okay, cool. And Ed, does that look good for you? And Gwen, is that showing up on your screens?
Yes, it is.
All right, perfect. All right, so let me do this. I'm going to go ahead and it's great to see everybody, but I'm going to turn off the little camera for me because that way it's not quite so distracting. As Ed said, we invite you to use the Q&A if you want to put some questions in, and Tom will answer the ones that he can, or he'll hold the rest to the end, and we'll get started. So today we wanted to talk about some very basic things, just like how to get an SBA loan. If you're out there in the market, you've probably met a small business owner who has an SBA loan. It's pretty common for people to talk about getting an SBA loan, and that's because the Small Business Administration loans are super, super popular. Over the course of a given year, we do at least 50,000 SBA loans in the country, and then about 4,000 of those are in the great state of Ohio. So they're very popular. They're not so hard to get. I don't want to underestimate the amount of time it takes or the work that it takes. But I did want to make sure that everyone understands that it's a very common way to get capital for your small business, and in particular, if you've got a relatively young business. So today I hope to go through these 5 main bullet points. How do banks evaluate your business and your business's health and your readiness for a loan? Understanding your personal and business credit, understanding your financial capacity, understanding your capital, and sort of what to expect when you go on this journey of getting a small business loan, whether it's through the Small Business Administration or a conventional loan or through some other economic development partner, what to expect and how you can get help on that road. Before I get into any of that, though, of course, I do work for the Small Business Administration, so I would be remiss not to give you an update on what the SBA's loan programs are. Of course, in the government, we have programs. The 3 programs that we have that address getting small businesses access to capital are these 3. It is the 7A Loan Guarantee Program, the 504 Real Estate Program, and the Microloan Program. So let me talk about each of those in turn very briefly. So the 7A loan program is what we call our flagship program at the SBA. And there's not really anything magical about that program at all. All it is where you, as a small business owner, go to a bank or a credit union, apply for a loan, and then that bank or credit union, as they're looking at your deal and analyzing whether it's something that they can do, they decide that there might be a little extra risk. A lot of times it's because of a lack of collateral or a lack of track record of the business. That credit union or bank will reach out to the Small Business Administration through an electronic system, and they'll ask us to guarantee their loan, which is kind of like just like insuring their loan. And when we do that, which we do all the time, It makes it much, much easier for a bank or a credit union to extend credit to the small business owner so that they can buy a new piece of equipment or get some working capital or buy a piece of real estate. 7A program loans are very flexible. They can be for anything from working capital all the way up through a 25-year loan for real estate. The thing to remember, of course, is that the toughest part is not being eligible, but the toughest part is actually getting approved for the loan, convincing the lender who you're working with that you're a great credit risk. Now, the 504 loan is a little bit different. You remember I said with 7A, what we're doing is we're guaranteeing somebody else's loan, and that induces them to give a loan to you. Under the 504 program, it's quite different. In the 504 program, what we do is we sell a bond in the market, and because the government has a pretty good credit rating, we're able to borrow money from the public really cheaply. And then we turn around and we re-lend that money through an entity called a certified development company to you as the small business owner. So it provides it almost swaps in the federal credit rating for the small business credit rating. It means you can get a longer term fixed interest rate below market loan that you wouldn't be able to access without us. So that's the 504 program. It's very specific in terms of what you can use it for. It's real estate, heavy equipment, or the refinance thereof. Most 504 projects are $250,000 and up, whereas the 7A guarantee program, the median size is like $150,000, but they go all the way up to 5 million. So 504 loans on average much larger than 7A, and that's because they're very specific. Real estate, heavy equipment, new headquarters situation, or a new building or construction, that kind of thing. Not generally just like a working capital loan. And then the last of the programs there, beyond 7A, beyond 504, is the microloan program. And what that is a non-traditional or sort of alternative loan program for micro businesses that typically can't get a loan through a bank or a credit union or a certified development company for one reason or another. And a lot of times it's someone who's coming back from a deployment overseas. Maybe it's someone who has had a divorce or some other situation in their life that's led to a circumstance where their personal credit isn't that great, or their business is just so new that there's not enough track record for one of the more traditional lenders to offer credit. So the micro lender here in the state of Ohio goes by ECDI, the Economic and Community Development Institute. That's our number one source for microcredit here in the state. And that is the purveyor of the microloan program here.
Hey, Ray.
Yes, Ed.
Hey, one question. Uh,
Absolutely.
can you give us like a range of dollars for a micro loan and a range of dollars for your 7A loan
Yeah.
guarantees?
Yeah, absolutely. So, like I said, with the 7As, it's super flexible, and the median on a 7A is probably like $150,000. That sounds like a lot, and probably is a lot for many of the small businesses that are in attendance. But the 7A loans actually go all the way up to 5 million. But there's a very long tail, if you can kind of envision it on that program, Ed. The vast majority of deals go in between that $50,000 and $350,000 range. And then there are a few $1 million deals and a few $5 million deals every year in Ohio. A lot of those are like big business acquisition type of situations. But the vast majority of it, if you can kind of envision it, is like a leasehold improvement loan for $100,000 for like a subway, or a $50,000 line of credit for a tradesman, or a $40,000 loan for a new contractor's van. Does that make sense? Does it help you kind of envision what those are?
Yep. Yeah.
All right.
Yeah. What about the micros? It's
Yeah.
below the 50,000 mark?
Yeah, exactly. So SBA microloans are $50,000 and under. And there we're really thinking about alternatives to a carried credit card or something like that. Microloans have interest rates around 10 or 11%, but they're really designed to be like small amounts of working capital that a micro business needs to go from one employee to three employees, or to demonstrate the viability of their product. So maybe like a $5,000 loan or something. It really provides a great alternative for people who maybe don't have a lot of money, but want to
Mm-hmm.
just start like a home-based business or something.
Mm-hmm.
So hopefully that kind of helps.
Do they charge a fee whether they approve your loan or not?
Um, as far as the microloan program goes, there probably are some nominal application fees. I don't recall exactly what ECDI charges these days, but it might be like a $50 application fee or something. I would have to look that one up. I'm
Okay.
not sure. But
All
you know,
right.
all of these programs are federal programs, so we have sort of our eye on what the lenders charge. We do let lenders charge fees on 7A and 504, but we don't. We kind of have a cap on what they can charge, if that makes sense. Same thing
Great.
with interest rates, actually. We offer a lot of flexibility, but there's a limit. So, all right, let me move on.
Ray, we do have a cut questions. Does 7A cover
Mhm.
lease lending?
Lease
I,
lending.
I guess that what that means is that you're leasing a place that you can get equipment for. I think that's what
Yeah,
they mean.
you could get one of those loans for for equipment in a lease space, but it doesn't do like lease financing, if that makes sense. Like, you know, we do um, ownership, so you're taking title to the asset. All right.
Okay.
So when lenders are looking at, Ed, did you have another question? I'm sorry, I
No,
want to change
no,
my slide.
not
Okay.
at all. Not at all.
Yep. Let's move forward here. We got some ground to cover, so for sure. All right. So when lenders are looking at a small business, the most important factors they consider are these things called the 5 C's of credit. Now, a lot of small business owners will call Tom or me at the district office and ask whether they're eligible for a loan. Being eligible for a small business loan from the SBA or through the SBA through one of our lenders is pretty easy. To be eligible for a loan, you have to be a small business, so figure under, I don't know, 500 employees. There's differences per different NAICS codes, but if you think you're a small business, you probably are. So say under 500 employees for small, you have to be for profit. You have to provide an active product or service. So we're not making loans to just straight up landlords, but that's pretty simple. Being a U.S. citizen, also pretty simple. Not being debarred from business with the government, pretty simple. The toughest thing in getting one of these loans is not being eligible, but rather proving to the lender and potentially to the U.S. Small Business Administration itself that you're a good credit risk. We accept more risk than a bank would consider just conventionally. But we want to make sure that if we're extending credit or assisting a lender to extend credit to a small business, that they're in a very good chance to succeed. We never want to have a situation where we have to foreclose on collateral because that makes everybody miserable. So we ask our lenders to make prudent choices and to investigate the character, capacity, capital, collateral, and conditions that would make a small business successful. And the three that they are asked to focus on the most in an SBA situation is character, capacity, and capital. Collateral, that is the ability of the lender to make good on any loss through foreclosing on assets, is not considered that important to SBA. SBA feels like we're here to mitigate that issue. So collateral is not a reason for an SBA loan to be turned down. And conditions is kind of like a given. Like if you're trying to do a fax machine repair business in the age of the internet is just not going to work. So that's kind of a default yes or no. Are conditions right for your business or are they not right? If they're not right, don't do the deal, no matter how strong everything else is. But character, capacity, and capital are things that we ask them to look at, and they are things that small business owners have some agency over themselves. So you can improve these things and improve your chance of getting an SBA loan or really any kind of loan if you focus on them. So let's take a look at each one of those things in turn. The first one in that grouping was character. And when we look at character, we really assess character through the lens of credit. And by credit, I typically mean personal credit. So another super common question that folks ask when they call into the U.S. Small Business Administration is, hey, I'm looking for a business loan. Aren't you interested in my business credit history? And the answer, of course, is sure, our lenders do tend to be interested in your business credit history, and you should take steps to make sure your business credit history is excellent. But I'm here to tell you that most lenders are really looking hard at your personal credit history. And the reason for that is because it's a very easy way for lenders to quickly assess whether someone's going to handle their business credit because people tend to handle their personal credit and their business credit in the same way. If you're not paying your personal bills, you're probably not going to be able to pay your business bills as well. We want to make loans to folks who have a really solid personal financial situation because businesses are notoriously variable. There might be a bad month when you can't draw what you need to. So you need to be able to have some reserves on the personal side. So we want to make sure that it's a business that shows good quality personal credit history from the owner, and the business credit history is important as well. But focus on the personal credit history now if you're looking at getting a loan for your small business in the next year or so. It's probably one of the best things you can do today to prepare your business for a loan in a year is to look at your personal credit history tonight. The importance of personal credit is higher the smaller a business is. As the business ages and as your financial needs get bigger on the business side, your business starts making millions of dollars of revenue. Maybe it's got $20 million of revenue. So we call it like a middle market type of business. Those types of businesses can start to apply for non-recourse, meaning non-recourse against the owner types of debt. And business credit becomes increasingly important. But until you get to that level, until you're a multi-million dollar revenue type of company, the importance of personal credit is really paramount. We look at the personal financial situation of the owner as one of the defining characteristics of character when we assess the character of the owner. Do you have a good personal credit history? So let's talk about that some more. What is personal credit? What is a personal credit score? So personal credit scores are generated by several different consumer credit reporting agencies. The names that we're familiar with, Equifax, Experian, TransUnion. And the scores they generate might come under different names. You'll hear of scores like FICO or Vantage or, I don't know, Fair Isaac. Many different little models with variations on them between the different lenders. But higher is always better. And in most cases, whichever credit agency that lender tends to be using, a score of 700 is considered median, a score of 800 is considered excellent. And if you're below 700, it becomes a little bit more difficult for you to get a loan. The different agencies look at determining their scores through different models, but it's all very similar behind the scenes in terms of how they come up with the number. The most important factor that personal credit agencies look at is past payment history. So the FICO score is probably one of the more common ones, and as you can see, that is based on past payment history at a 35% weighting. The level of outstanding debt is given a 30% weighting, and then the length of credit and any new applications you've had for credit and the types of credit are given smaller ratings. And Vantage score tells us really the same story, right? Extremely influential is your past payment history. Age is highly influential. Your balance versus your credit limit is highly influential. And then things like recent credit inquiries is less influential. But knowing sort of what these different things are that influence your personal credit can help you over the course of 6 or 12 months to bring your score up. And I'm definitely here to tell you that bringing your score up is what you want to do if you want to get a business loan. This model on this page sort of tells you sort of what the scores range. 650 to 700 is considered fair. Around 800 is considered excellent. Once you get to that level, below 625, when you're in the 600 and below range, the cosmos of lenders that are willing to lend to you gets to be smaller and smaller, and their terms tend to be tougher and tougher. To the point where if you have a need for credit and you have a poor credit score, many of these lenders in that spectrum are, potentially predatory lenders. And you have to be really careful that the loans that you would get from them are the kinds of loans that you really want to have. By contrast, once you get your credit score trained above 700, which you can do, the kinds of lenders that you want to work with tend to have relatively favorable terms, and you tend to have more than one option. You want to have several different options you can kind of look at. So getting your personal credit score above that 700 level unlocks a whole universe of possibilities as far as the kinds of lenders that you want to work with and more options.
Hey, Ray.
Yes, Ed.
Charles had a question. He says, what if I have cash on hand along with the 700 score? It's a good thing, right?
That's good. The more cash, the better. So the three C's that I want to focus on, character first, and then what was the second one? Was it capital that was the second one? I don't remember whether that was the second one or
Yeah.
not, but the
Amount
Capacity.
or capital, yeah.
okay, capacity was next. All right. Capital was maybe the last one. But capital is one of the big three C's, the amount of money that you have to contribute to the project. So we'll come back to that one. But let's get character done first and hit capacity. And then the questioner, Charles, I think that had great credit and good capital, you're on your way. You're in good shape. So personal credit, best practices, things you can start doing this month to get yourself in a good position for a business loan request. Next month would be pay your loans on time every time. Make sure you're not getting close to your credit limit on your credit cards. A longer credit history will help your score. So there are definitely some folks out there that never use their credit card. They don't want a credit card. They hate credit cards, and I applaud you. But it's also helpful to have that credit history. It will help your score in the long run. Only apply for credit you need. So use credit, but use it wisely. Don't go out and open up a bunch of credit cards just because you think that'll help your score, because in the short term, it really doesn't. You want to have a long history of paying as agreed. And then, of course, fact check your credit reports, right? Like, so get your annual free credit report, take a look at it, make sure there's nothing on there from your mom or from your cousin or from your kids or whatever. Don't let other people use your credit. Be very protective of your credit score. Some folks actually go out to the extent they freeze their credit, which means that it's protected and other people can't check your credit, or if there might be some kind of identity theft protection you're looking at there. And a good like practice pointer would be before you go for your business loan, make sure your credit is unfrozen, because a lender that tries to hit your personal credit to investigate your character, if they see the 998 score, it's like a signal that you've frozen your credit and they won't be able to access your credit score, and that could be awkward to have them rerun their credit. So make sure that you've unfrozen it if you decide to do that before you
Oh,
go for
yeah,
loans.
right. There's a
Yeah.
question here. They had
Mhm.
a 720 and it always paid on time and don't understand why. It always goes down. Now it's 706. They're frustrated about that, but credit, don't know all the factors why it
Yeah.
would go down a little bit, but
Great question. So usually when you draw a credit report, it will tell you the factors that are pushing down the score. But you do have to, I think you might have to pay a little extra to get the actual score. Like, I don't think your free credit report is going to have that. But if something is pushing it down, usually on the credit report, sort of at the bottom, it'll tell you factors impacting the score. Um,
when I pull on a credit report, that knocks it down slightly, doesn't it? I don't know if that's
it depends. A lot of times it can if you're applying for credit and you've got sort of that, you're applying for a lot of credit at one point in time. Now, supposedly the credit agencies know that if you're applying for a loan and you sort of have three different lenders hitting your credit at the same time for the same purpose, supposedly from what I've read, it's not supposed to drive your score down, but I think it does. But if your score is fluctuating a lot, I would just suggest getting aligned with Ed and some of the other mentors, and taking a look at this at the report and seeing if you can kind of ferret out what's happening there. It might be that you've allowed that balance to creep up towards the maximum, something of that nature. Tough for me to say.
Is there somewhere they can go if they need help with their credit, fixing their credit?
Yeah, you can. I would think that the mentors at SCORE would be, one group that would at least be able to provide you some guidance on it, just some, common sense guidance. But you can also call the credit rating agencies themselves and look for guidance there. Lots of websites online from trusted sources like the Federal Reserve Bank, the Consumer Financial Protection Bureau, and others provide some guidance on that as well.
I think
You know, on,
David put in there about myfico.com. So there's a site to
okay,
go to.
could be good too. Just be careful where you're going. Make sure that it's a legitimate site, and that you're not putting information in there that would take advantage of you.
And then Brian said that FAMX Foundations offer a free service for people in Cuyahoga County looking for one-on-one assistance.
Nice.
a subscription service. So
Very good. I've heard Operation Hope will also do some credit counseling. Your local small business development center might have some good sources as well. Such an important thing to get that credit score up. It makes it so your business is going to have access to capital. So not to be underestimated for sure. Any other questions on personal credit before I kind of move on to some of the, just briefly on business credit?
I think we're good.
Okay, great. So on the business side, I don't want to underestimate that business credit reporting is important too. So there are some agencies that sort of dominate business credit reporting. The big one is Dun& Bradstreet for sure. Apparently Equifax and Experian Business also are involved in business credit reporting. You'll hear other names like LexisNexis and others. And I think it makes sense to keep an eye on those. Being just like having your business be visible always helps because when a lender has got an application from you and they're trying to find out more about you, they may very well try and draw a Dun& Bradstreet score. And if your vendors are reporting that you are paying as on time on your trade agreements with them, and they're reporting that to Dun& Bradstreet, that can be very helpful. Again, I think that most small businesses, I mean, you got a lot to do. Usually it's a 1 or 2 person shop. I would spend 100% of my time working on personal credit, and 0% of my time working on business credit until I knew I had some vendors that were reporting on me and that kind of thing. So yes, important at the micro stage of the business cycle. I wouldn't spend a ton of time on it. It's worth thinking about, but maybe save that until you're 4 or 5 years in business or so. So some business types of information that a business credit report might obtain would be business names and aliases, DUNS number. DUNS profiles tend to have industrial classification codes and just baseline information about your business. Again, if a lender is trying to research up on you and you can make sure that that information in Dun & Bradstreet is up to snuff, that's definitely something to do. Business credit history, business background, affiliations, your history. Many of the business credit reporting agencies will pick up on liens that a lender has filed against you. And that's not necessarily a bad thing. Like if you have a credit from a bank or something, they're going to file a lien against your equipment. But that sort of credit record would be something that would show up in many business credit reports. Also, if you've got any lawsuits or tax liens against you or judgments, that's sort of public information, it might show up in a business credit report as well. So don't be surprised if you have something like that and you send in an application for a loan and the banker comes back and says, "Hey, yeah, I drew a credit report from Dun & Bradstreet and it shows a tax lien. What's the story there?" That's certainly quite possible.
yeah, Ray, we do have a question about if any of these business loans would show up on their personal credit. I think they would if they're using your social security number. That
Yeah, it could happen. It probably shouldn't. If it's a business loan, it shouldn't show up on your personal. But a lot of times there are sort of gray areas, right? Like people run their business as a sole proprietorship, or the business will be, they'll have the business's property under their personal name rather than under an LLC or something.
yeah, we did have an earlier question about applying for a loan. Should you use your personal social security number or business EIN?
Yeah.
I guess you could do either.
Yeah, I mean, I think we always advise people to make the primary borrower their business if they can, file under the EIN, but that does not mean that you're not personally liable for most of these small business loans. So very likely the business obligor is your business, with that EIN number. But in most cases, the substantive owners of the business are going to be personal guarantors, meaning you're signing a document that says that the lender can sue you personally if the business isn't paying the loan. It's very unusual for loans to be non-recourse at the small business level, because like we said in the character section, it's really so closely aligned, one and the same. All right, beyond character, the second most important thing in the 3 big C's that I wanted to discuss today is capacity. And this is a non-negotiable one. Your character is important, your management ability, your personal credit history, those sorts of things. The ability of you to show you're a great credit risk on a personal level is super important, critical important. But the business also has to be able to show the ability to repay the loan. So when you talk about getting a small business loan, are you eligible? Yeah, you're probably eligible. Do you have good personal credit? Great. Do you have good management ability, experience, and so forth? Wonderful. Character +5. But what about capacity? When I talk about capacity, I mean that question of, can you convince the lender that your business has the ability to repay the loan? And the way that the lender assesses that for you is they look at your financial statements. That's one reason why it's so much easier for businesses that have been in business for 3 years to get loans than businesses that are startups or new businesses, because the startups don't have the tax returns and financial statements to look at, whereas the existing businesses do. So the financials you'll no doubt need to bring to your lender include 3 years of business financial statements and an interim financial statement. And by interim, I mean something current within the last 90 days or so. So what are we looking at? It's March 19th now, so you might be looking at your year-end statement from 2025 might still be good for a few more days, but you might want to prepare like a February statement, a 2-month statement for your lender if you're looking at going in for a loan today. 3 years of business tax documents. So you want to have your 25, 24, and 23 business tax returns and personal tax returns. The third checkbox there is indeed personal financial statements and tax returns. A personal financial statement is just showing what your assets and liabilities look like outside of the business. So it doesn't include your business assets and liabilities. It's just your household. And your personal tax returns would be your IRS 1040. Now, in some cases, especially for micro businesses, they're reporting their business on their 1040 through Schedule C, in which case, of course, you're not going to have business tax returns. You'll just have the personal tax returns. And lenders understand that. Adding a debt schedule in, showing what you owe, would be key. And especially if you're a startup business or a new business, a very good quality set of financial projections will be required. Usually, if you're a startup business, a bank is going to want to see the first 12 months itemized monthly rather than summarized annually for those financial projections. So what do these financials look like? Hopefully you're not too intimidated by looking at a financial statement because I've got one flashed up on the screen. I just kind of want to give you a sense of what lenders do when they look at your financials. So what I've got flashed on the screen right now is actually a comparative balance sheet document. It shows what the business's asset and liability balances have been at certain key points in time. This is a little bit of a dated form, so it says 12/21, 12/22, and December of 2023 with an interim of June 24. But just advance all of those dates if you want to sort of pull it current. When you send a financial statement into a lender, a lot of times they'll take those financial statements and they'll rewrite them in this sort of comparative section so they can kind of see, well, gee, this business, how has its cash balances been fluctuating over time? How has its assets been fluctuating over time? What have the liabilities looked like at the end of each of the most recent 3 calendar years? Has long-term debt been increasing or decreasing? Has equity been increasing or decreasing? So when you send in tax returns and financial statements to your borrower, this is what they're doing with them. They're taking a look over time to see how the numbers have changed. And then if there's a question, they'll turn to you and ask, why did this happen? So a great exercise for you to do to prepare for your loan ask is to take a look at your financial statements, perhaps again with your mentor, and start talking about why some of the numbers have changed over time. Why did cash go down from one year to the next? Maybe you had a tough year, or maybe you just took out more money for your distribution, whatever the case might be. But you want to have a good answer for that lender. Income statement, kind of the same thing. What I've got here for you is an income statement with columns that are sort of based on each of the most recent year ends. Now, an income statement is different than a balance sheet. Balance sheet is like a snapshot of your business at a single point in time. What's your cash value right now? What is the asset value right now? How much do you owe right now? The income statement is a flow statement saying what happened in the last 12 months with the end date of 12/31/2024, for example. It shows what revenue you received, what costs you had. The lender takes those different financial statements that you submitted, your tax returns or financials, and they put them into this format so they can see what happened over time. Did your officer's compensation increase? Congratulations. Did your salaries and wages decrease? Did you have to let people go? Does your rent increase or decrease? So you, again, take a look at your financial statements, know that the banks will be sort of looking at this as they assess your application and be able to answer questions confidently when they come back and say, what happened here? When we talk about capacity, what we're really talking about is the ability that your business has demonstrated to generate cash to pay a loan. And although this looks like heavy math here, it's very basic. Everybody can do it. What the lenders do is they take your profit, they add back non-cash expenses, and traditionally that means depreciation. So your profit plus non-cash expenses like depreciation equal the amount of cash that you have to pay a loan. They divide that cash figure by the payment amount. Usually it's on an annual basis. So they summarize every monthly payment and they divide by your annual obligation. And as long as you can show that you have cash flow coverage at around 1.2 times, meaning you got $1.20 of cash for every dollar of debt service, you tend to be able to justify a loan request. And the reason I'm kind of giving this math to you is that you can do this yourself. You can look at your tax return, you can add net income and depreciation, you can come up with a cash flow figure, you can think about the amount of the loan that you're requesting and what the payment would be on that. You can figure that out very easily with an online calculator and just make sure that you have the ability to pay the loan. If you haven't done that exercise, if you really have no idea whether you have the cash flow on a monthly or annual basis to pay the loan back, you really haven't done your homework, because this is the secret ingredient that most lenders look at after they assess your character through the lens of your credit. After they assess that, they're going to say, okay, great, that's all checks out. Does the business have the ability to pay the loan? You can do this. You can take a look at it. You can even look at what your cash flow is and kind of work it back into what kind of a loan size you can request. In order to do that analysis, of course, it's very important to understand how much debt you have. If you already have debt, you're going to need to factor that into your debt service coverage analysis, right? Because you have to be able to cover all of the debts, not just the one that you're applying for. So again, calculating debt capacity in this example would be, let's say you had operating income of $100,000 and you have depreciation. Let's say you had net profit of $80,000 and you had depreciation of $15,000. An interest expense of $5,000. You sum those up to $100,000, and then we divide by the proposed and existing debt service of 80, and very simply come up with a 1.25 debt service coverage ratio. So very simple math, just trying to determine whether you have enough cash flow to cover the loan payments. Now, if you're a startup business or you're looking at a projection-based financial statement, providing the lender with a monthly cash flow would make a lot of sense. SCORE has developed over the course of time really good monthly cash flow projections that your mentor can kind of go over with you. But the key thing here is really understanding for yourself how the cash will proceed through your business. In your current month, how much your sales are going to be in month 1, in month 2, in month 3, et cetera. Figuring out how much your purchases will be. Really looking at any seasonality that you might have, any purchases you need to make, in a big lump up front. And just making sure that at the end of every month, you're going to have enough money to pay that loan. Cash flow projections should always be feasible and attainable. Every single line item that's on this Excel spreadsheet here, purchases, wages, supplies, there should be some assumption behind it, and you should be able to defend every single row there with what you use to help determine it. So if it's utilities, what's that based on? If it's rent, what's that based on? For any business that you have, whether it's a car wash or whether it's a chiropractor's office, you'll be able to project your revenue and then be able to project your expenses and have the supporting documentation to show the lender. So we talked about character and we talked about capacity. Character, usually determined through, a review of your credit report, as well as maybe your resume and your experience. And then capacity as determined by your financial statements, and especially your cash flow coverage. All right, I'm going to pause for a second. Tom, was there anything in the Q&A about those two?
Yeah, well, there's so what's the ratio? 1.2. They must mean debt to net worth.
Well, the 1.2 is cash flow coverage. That means
Gosh,
you have
okay.
to you have to have $1.20 or $1.25 of cash on a monthly basis, for example, or on an annual basis, whichever time period you choose, to cover every dollar of debt service that you have. So if your company generates $1,000 of cash after all its expenses per month, you'll have $1,000, and your debt service per month ought to be no more than like $800. So do that analysis, at least some kind of flavor of that. I think most of the entrepreneurs I work with have sort of an instinctive idea of how much cash they end up with at a given month. But really start tracking that. And when your lender says, hey, I'm not sure you have the capacity to pay the projected loan back, make sure you can defend that and say, yeah, on an average month, I have $1,000 of cash left over, and I can clearly afford an $800 payment. Okay. So those are the two most important things with character and capacity. But the third thing that I wanted to get into is capital, and that was one that Ed had mentioned earlier. Someone had put in, hey, what if I have a good amount of money to put in? And that is fantastic. Lenders want to see that you have a good reserve. They want to see that you have skin in the game, and they want to see that you have as much equity as possible. So here's a question for the crowd, and I guess you guys can drop this into the chat or the Q&A. What is skin in the game, and why is that important to lenders? And how much equity do you think you need to raise to be able to leverage a small business loan? So I'm going to pause for a second. Hopefully, some folks that are engaged out there can throw in what they think a good definition of skin in the game is and what that means. And I'm going to pause to take a drink of water, and then I'll come back to it. So, Ed, Tom, do we have anybody with guesses as to what skin in the game is?
Not
Not
yet.
yet.
We got other questions, but not
Not
that
that
right
one.
now.
All right. Well, Ed, I'm going to ask you then. Put you on the spot. You're an experienced mentor. What does skin in the game mean to you? What do you think that means if a lender said,
Well,
"You got skin in the
skin in the
game"?
game to me is I'll give you an example.
All right.
When we tried charging for workshops,
Mm-hmm.
$10,
Mm-hmm.
um, and so the registrants would have some skin in the game. They'd have
Mm-hmm.
$10 into it, so more than likely they would attend the webinar.
Mm-hmm.
So
Sure.
if I don't know if you could convert that to
Loan?
Webster's dictionary version or not, I don't know.
Yeah. Did it work?
We,
Did you get
No,
more committed
no,
people? No.
no.
All right. Fair enough.
Ray, we got a couple people like
All right.
man that says what we have to lose.
Yeah.
That's
Yeah.
what's that.
What we have to lose. Right.
Equity that a borrower can put into a deal.
Yeah.
That's part
Yeah.
of it too. Your
Sure.
personal investment, owner's
Yep.
capital,
Owner's cap. Yes. Good.
personal
Okay.
investment, 10 to
Personal investment.
20%.
10 to 20%.
Skin
Okay.
in the game is money or equity you bring to the table. You should have 10 to 20%.
Yes.
What we have to lose
Yes.
or gain.
Okay. I think people have a good instinctive idea of what skin in the game is. Let me see if it'll populate. So yeah, skin in the game means you have some of your own funds and not just the lenders at risk. Lenders believe this will keep you engaged. I guess just like score mentors believe it'll keep you engaged. It is also an indication of your past ability to save money or raise money for investors. It is also an indication of your past ability to save money or raise money from investors. And both of those are great skills for a small business owner to have. So yeah, skin in the game. Lenders sort of live in fear, right? That they will make a loan to a small business that makes who's it called it's whatchamacallits or thingamajigs. And one day the thingamajig maker will come into their office, drop the keys on the desk, and say, you know what? I've had it. I can't make another thingamajig. You make the thingamajigs. Good luck. Of course, lenders have no idea how to make a thingamajig. So they do not want you to come in here and drop the keys on the desk and say, it's all yours. So they think that you're going to be engaged if you have something to lose, just like the person put in the Q&A. If a small business owner walks into the office of the lender and says, hey, I need $1 million to make a thingamajig factory. And oh, by the way, you're going to give me $1 million. The lender is going to be like, heck, I am. Why should I be on the hook for this whole risk? They want to see some kind of equitable distribution of risk. And when I say equitable, I mean equity injection, and the more, the better. usually a 10% equity contribution, especially for a startup business, is like the bare minimum. You should really strive to have 20% or more. And that's really helpful to think about because if you're an entrepreneur and you have access to $1 million, that might mean you are in position to leverage a $5 million loan or more. Now, if you're an entrepreneur and you have access to $1,000, that might mean that you're not in the position to go for a $100,000 loan. It might mean you're more in the position of trying to leverage a microloan, and that's okay. Entrepreneurs don't have to get to the final destination in one jump. It can be an iterative process where in year one, you get a $10,000 loan from the micro lender. In year two, you get a $30,000 loan from a credit union. In year three, you get a $500,000 loan from a bank. And in year four, you get a $5 million loan from a certified development company. So you kind of manage that growth. It doesn't mean that your dreams are dashed if you don't have a ton of equity, but it does mean that you might want to start a little smaller, or it might mean that you might want to raise equity from investors, friends, family, and that kind of thing. So aim for a 10% equity contribution into your project at least, and 20% or more. When you go and talk to a lender, you're going to have a conversation about your character. You're going to have a conversation about capital and capacity. And when they ask the question of, do you have capital of your own and to invest it, you definitely want to be able to say, yes, sir, I have $10,000 that I can put in your bank tomorrow if we decide that this is a good opportunity for both of us, right? That's kind of where you want to be. Now, for existing businesses that have a ton of balance sheet equity already, so if they look at that snapshot of their business and there's a ton of net worth there already, you may be able to get 100% financing on your asset purchase or something because you have so much equity in the business already. But for a startup, especially or a new business, plan to have some cash of your own to put into the operation and some more for reserves as well. So when we talk about net worth, just to summarize and clarify that for everyone, net worth means the difference between what you own, that is your assets on your business's balance sheet, and what you owe, which is your liabilities on your balance sheet. Be the same thing on a personal financial statement, on a business financial statement. Your net worth is the difference between your assets, what you own, and what you owe. And you want to have your assets be higher than your liabilities. So in summary, getting approved for a loan, whether it's an SBA-backed loan or a conventional loan or whatever, means having great character, demonstrated by your personal credit report, having the capacity at a business level, at an enterprise level, to pay the debt service on your loan, and that's usually determined by your debt service coverage ratio. And finally, capital, as demonstrated by your contribution to the project and your business's net worth. When you're going for a loan, just real tangibly in just like 2 minutes, I'm going to kind of go through what a business loan application kind of looks like. Kind of, I say, because most of these things are online now, so it's not a piece of paper like you'd kind of implied here by looking at the screen. But it's the same information. Rather than a piece of paper you're filling out, you're really doing it online. So having a completely filled out, legible application that someone has put some effort into is pretty important. When I would get these at the lending institution that I worked for, I could tell kind of immediately whether it was someone I wanted to work with just how much care and effort they had put into filling out my application. If they kind of scrawled across the front of it, "Please see my business plan," or "not applicable" all over it, I would probably be like, okay, well, this is not someone I want to work with because they didn't spend any time or effort on the application. So fill it out completely and let the application kind of be a guide for you as to what the lender is looking for. So on the right-hand side here, you see the actual application that ECDI, our economic development microlender, used to use. But observe especially the kinds of questions they're asking. For example, about halfway down the page, they ask for a federal EIN number. Now, what if your company's been operating as a sole proprietorship and you don't have an EIN number? Well, they're asking for one, so maybe you think to yourself, maybe it's time that I went and got an EIN number and started operating my business as an LLC or something, right? So maybe this is a good guide. Maybe I should go ahead and get an EIN number. And look over here, they're asking for a DUNS number. Well, that's Dun & Bradstreet, so you know that they're probably checking business credit. Well, how about that? Maybe I should check my DUNS profile, get a number, and make sure it's up to date. Type of entity, LLC, partnership, corporation. If you're saying to yourself, I have no idea what kind of business entity I have, talk to your mentor or talk to your SBC advisor and figure it out. So don't just leave it blank. Company ownership in the same way. Look how the information they're asking for, percent of ownership, full name. Maybe you're not sure of who the owners are of the company. Well, figure it out and make sure you can answer this completely. If one of your owners doesn't have an SSN and or doesn't want to provide the SSN and the application is looking for that, maybe you need to have a conversation with them because the lender is probably asking for a reason. They're probably checking to make sure someone's not debarred or on the list of folks who have been determined to be terrorists or something like that. So if you're not able to fill out an application completely, take a second look and make sure that you truly can't. As a rule of thumb, most of the time lenders want to see full information on all substantial owners of a company, and usually that's like a 20% level. So for SBA loans, we want to know everybody. Most lenders are going to be satisfied with 20% and greater owners, but if it is an SBA, we need to know social security numbers and citizenship and place of birth and residency for everyone down to the 1% level. Be prepared for that. If anybody in your management group isn't going to do that, then you already know that you're going to have some trouble. So the next page in the application I'm looking at included questions about your employees, the number of employees, full-time equivalents, who the key employees are. It's got a section for the history and description of your business, key customers, major competitors. Make sure you're filling out everything completely. The next page talks about your project. So if you really don't know what your project is, you're just kind of fishing to see how much you can get, that is not a good place to be. Make sure that when you go to a lender, you have a crystal clear ask, not just as much as I can get, but something specific that will help your business grow with the exact cost of that thing. Look at this here in the application under real estate purchase price. The lender says you must provide your purchase agreement. So they're not interested in if you're just fishing for how much you hope to be able to buy on a piece of real estate. They're really looking for what is the actual price on the executed purchase agreement. If you don't have that, again, maybe you are not ready to apply for a loan. Oh, debt schedule was the next page on here, and we already know about debt schedules because we talked about it in the context of capacity determination. Checklist. What are they asking for on their checklist? Well, they're asking for, look at that, business tax returns. We know why. Business plan and history. Personal documents. They're looking for a resume. Okay, that's important for character. Federal tax returns. Good. Personal financial statement, and so on. So this is all kind of familiar now because we talked about this. And the last page of most applications is sort of the authorization and legal stuff where you're authorizing the lender to do what? To draw credit, probably. So if you are not ready for them to draw your personal credit and to get information, potentially confidential information about it, about you and about your other owners, then don't sign this. But it's going to come to a point where they're going to need you to sign it because you know they need to do their credit investigations to get you to an approval. So take this seriously. Maybe be a little bit circumspect about allowing lenders to draw your credit until you really feel like you're in a good space with them. But eventually you're going to have to sign this authorization. SBA does have its own applications. The lenders will give them to you if they decide to go the SBA route. But if you do want to, you can take a look at the SBA Form 1919. That is a form that SBA uses for all of its loan applications. The bank will give it to you. You don't need to worry about it. But if you were to look at it up front and you want to sort of see what was on it and prepare, you can get that online very easily. Okay, final slide. You're probably going to need more help as you do go down this road of going for a bank loan. There's plenty of help out there for free. The district offices, for example, Cleveland District can help. There are many small business development centers out there. The SCORE mentorship program is delightful. Women's Business Center is here to help. The Veterans Business Outreach Center can be helpful for veteran business owners and entrepreneurs. And there's lots of other opportunities as well. All right, that's where we're at. What questions do we have? I know we're a minute over, but do we have anything else?
Right. It's one question. How do you guide a church that might need a loan to expand a project? What financials would be required to fill out the application? Churches aren't really eligible for SBA loans. They were under COVID, under PPPs and
Oh, a
title.
church. Yeah.
Yeah.
Well, churches do get loans. Usually those loans are based on the demonstrated ability of the church to have a capital campaign, the amount of capital that that business or that that church has to put into it. Of course, the worth of the real estate underneath it. There are dedicated church lenders that are out there that make those kinds of loans, but they are not the SBA. SBA does not support church lending. Only for-profit small businesses that have a service or provide that have a product or provide a service.
Okay, some other questions that we had here is I always can I get a loan to pay rent if I fall behind? Uh
You
maybe
want,
if it's
yeah.
working capital, but I mean it could be fall under working capital.
Yeah, but the thing is, you always want to get a loan to help grow your business.
Right,
If the
right.
question is, I need a loan because I can't make payroll or because I can't make rent, you're going to have a real challenge to get the lender to agree to that. You never want to bring on debt with interest and everything that goes with it to just make ends meet. Um, Lenders be really careful about that. If there were some specific reason, like, hey, I've got a big receivable coming in next month, and I just need to get through this month, perhaps some kind of a short-term loan would work out for you. It would be eligible, but you just be real careful with that. The debt is not the answer if you can't make ends meet.
Here we have a question that says own another small business. Started last year in May to generate a savings for my pastry project. How do I promote this business to get my $200,000 loan? So sounds like you already started your business and maybe you want to expand. Is that Saya? Is that what you're talking about or Santa?
Yeah,
But
she might need to rephrase the question, I think.
Well, here's the way I would react to that, just on the face of it, guys. I'd say businesses that start and get off the ground and can demonstrate product viability can have a conversation with their lender about scaling what they have. That's a better conversation than the pure startup conversation. So if you could show a tax return showing, $1,000 of revenue and $500 of expenses and $500 of profit, that helps. It helps demonstrate to the lender that you have a viable product, but you're still looking at coming up with really good financial projections to be able to demonstrate that you could make capacity to pay a loan back. So it's a good start, but uh, you know, you'd have to develop really good projections showing why additional equipment and the debt that goes along with it would be able to scale your business from, you know, X amount to 10X amount to be able to pay the payments. It's possible, but it's a projection based loan.
yeah, we got a question about the church again. It says the church is looking to create a for-profit entity to create a commercial project.
Mhm.
I think that's different if you're looking for a for-profit.
Yeah, it could happen. You could be SBA eligible if you're a for-profit business that has ownership by the church. But I think that's something to talk over with your lender and see what they want to do there. Usually, with SBA, for example, we want to end up getting down to the individual owner. And when you've got a not-for-profit owner of a for-profit entity, the not-for-profit doesn't have individual owners, so there's no personal guarantors. It'd be a real challenge to get that done through SBA. I think that would be more of something to look at through a specialty church lender.
Yeah, another question earlier was they're not. It sounds like if you're not a citizen, no loan. I'm from Paris and need $200,000 for my project. Guess you do have to be a U.S. citizen, or else you're not eligible for SBA financing.
Mhm.
So,
An important point is that SBA is not the only source of financing. Many,
right,
many more deals are done without SBA than with SBA. But you do have to be a U.S. citizen. Every single person in your ownership capital structure at this point has to be a U.S. citizen to get a microloan, a 504, or a 7A.
right. It says this is a kind of a funny question. It said Score mentors told me I have to split my loan request between SBA and Score. Um,
Hmm.
That's a
Score
strange
doesn't
one.
really make the loans. It's the lender makes the loans. Score just provides counseling and SBA provides a guarantee there.
I think Ed will reach out to you separately on that
Yeah,
one.
really.
Okay. Next question.
And then what is the advantage of getting an SBA loan versus a traditional bank loan?
Yeah.
Well, an
Go ahead,
SBA
Tom.
loan, I mean, you can basically hopefully get the loan and get the guarantee behind them. The bank,
Hmm.
SBA is taking the risk, more of the risk, so the bank might be more willing to do a loan than they would by themselves.
Yep. SBA keeps an eye on the rates and the fees that are charged, but primarily the benefit to getting an SBA loan is getting to yes. If you can get a conventional loan, take it. Yep. The public sector isn't here to make a loan where someone can get the loan on a conventional basis. Get the loan if the go to Chase and they can give you a loan, get it. Yeah, sure. But if for whatever reason the term would be better, or the interest rate better, or the fee structure better through SBA loan, or if indeed that's just the way that you're going to get approved, that the way you're going to get to yes, then SBA is a completely acceptable route to go as well.
A couple questions for that military veterans. This is, are there still support for veterans navigating a business startup process,
Mm,
including loans and Marine seeking information?
mm,
And somebody asked what the real benefits of Forward to USA veterans.
mm.
Well, I know we have fee relief and SBA loans. The veterans 500,000 below under SBA Express, so no SBA guarantee relief. That saves you 2%. Um, but we do have one of those veteran centers that can also help you too.
That's right.
Of course, you can talk to the score counselor too. They can help.
Is- Isn't
Definitely
there
want to help veterans.
isn't there someone with the SBA in Cleveland that specializes in veterans, a young lady?
Yeah, Naya, she's
No,
been
yeah.
out a while, but
Okay.
hopefully she'll be back here. But we can kind of direct you to the right people, if you let us know here. Still a question about it's like they have rental properties. So I have 100,000 and own two properties, want to demo and build and start up a rental portfolio. Uh, thing about rental properties is if it's for your own business, it's qualified, but if it's for just leasing out and not occupying, it's not eligible for SBA for loans or 504s there.
Okay.
So that's I know on COVID when PPPs and IDA loans rentals were eligible, but not under a regular loan program. Let's see what other questions. Trying to go back over the old questions there. Here's one. Does real estate include flip homes, or is it more like buy a commercial property for retail? Yeah, you can't really buy them to flip or fix homes. That'd be a passive investment. It's got to be real estate that you're actually going to occupy. Do SBA loans finance business purchases? Yeah, definitely. We definitely loans can finance business purchases.
Hey, Ann, we will be sending you a copy of the PowerPoint.
I'm looking. Oh, I think I might have all the questions. Is the handyman type of business considered services and eligible for loan? Yes. I mean that's a business for profit type business. Handyman, it's definitely needed.
Yep.
See, like 504 disadvantage loans or something like that. I don't quite get the question.
Yeah. Hey guys, let's pull the plug on this.
Okay.
If anybody has any questions, you can submit it to they're giving the group here is giving you a lot of different resources that you can go out and look for information. If you need SCORE to help you mentor, um, just go to score.org and request a mentor. It's pretty easy. And you're more than welcome to call the SBA up in Cleveland. I can see their district office information right there. So hey, with that, Ray, Tom, thank you so much for your time and sharing your knowledge about a subject that's near and dear to many people's hearts. We have a lot of entrepreneurs in Ohio. And thank you for those of you that are still on for listening in on us. So
Well, thank you guys so much. We appreciate it. We loved all the questions. And anytime you want us to come on and talk about what we do, we are delighted to do so.
great, great. Thanks again. So long, everyone. Have a good
So long.
weekend.
Bye now.
Thank you.
Bye bye.